Bitcoin bear markets and Bitcoin cycles as we know them are over. And no, I'm not saying Bitcoin will never have a 25, 30, or even 40% drawdown. I'm referring to the massive boom and bust cycles that Bitcoiners have become all too familiar with. In 2013, 2017, and 2020, Bitcoin made exponential gains within a single calendar year. However, each of these booms were followed by 75% drawdowns. Now, Bitcoin's volatility has created tremendous opportunities over the years, and it will continue to be volatile relative to traditional assets like stocks and bonds. But the historical Bitcoin cycle and the oscillation between boom and bust, extreme euphoria and extreme desperation, parabolic bull markets and devastating bear markets is over. We have entered the institutional era, and in this video, I'm going to break down exactly what this means and what you can expect and how you can best position your capital. When we look at this chart here, we can see a clear distinction in Bitcoin price action before the creation of the ETFs and after the creation of the ETFs. Before the ETFs, we had this aforementioned boom and bust cycle. Bitcoin had a relatively low market cap, retail adoption would happen in waves, there was incessant FOMO during bull markets, and followed by subsequent panic during bear markets. However, after the ETFs is an entirely different story. Bitcoin has steadily climbed higher, with drawdowns no larger than 30%. In fact, since BlackRock filed for the ETF in the summer of 2023, Bitcoin has not had a single day in which it had a negative year-over-year return. This means that if you've bought Bitcoin at any point during the last 3 years and held it for at least 1 year, you have made positive returns. Now, in order to better understand what the institutional era means, it can be helpful to understand what actually caused the historic boom and bust cycles in Bitcoin. First is the halving. Everyone knows about the halving. Every 4 years, the block subsidy awarded to Bitcoin miners, or more simply put, Bitcoin's inflation rate gets cut in half. The result of the first halving in 2012 was Bitcoin going from 7,200 new coins mined per day to roughly 3,600 new coins mined per day. Now, the most recent halving in 2024 resulted in Bitcoin going from having 900 new coins mined per day to only 450. The actual quantitative effect the halving has on the number of new Bitcoin entering circulation is diminishing. Another reason for cycles historically has been liquidity. The 2017 cycle was primarily driven by adoption. The creation of many popular Bitcoin exchanges that we know today happened around this time, allowing for investors to easily onboard into the asset class. However, the 2021 cycle was primarily driven by liquidity. There was a record amount of stimulus and quantitative easing in 2020, and this tsunami of liquidity saw every asset rise, including Bitcoin. That's not to say there wasn't adoption in 2021. There was plenty of it, but this boom was primarily liquidity driven. Now, consequently, each of these booms was followed by a bust. In 2017, many of these speculators who entered the market with not a great understanding of Bitcoin's technicals and fundamentals or the long-term ethos behind Bitcoin panic sold after Bitcoin peaked out at 20K and then began descending down. In 2022, you had some of the panic selling, but you also had liquidity vacuum. The Federal Reserve slammed on the proverbial economic brakes with the most aggressive interest rate hiking cycle in history. So that's a little bit of context into Bitcoin's historical boom and bust cycle. Now let's get into what makes it different today. Why the institutional era after the creation of Bitcoin ETFs has been so different and what we can expect going forward. First, we'll simply take a look at a chart that removes all subjectivity. It's purely an objective look at Bitcoin's realized volatility. So it's annualized 365-day realized volatility. And during the entire duration of the ETF era, Bitcoin's realized volatility has been less than where it was for 95% of the pre-ETF era. So regardless of your opinion on Bitcoin bear markets and the future of Bitcoin cycles, it is objective, and the data tells us for a fact that Bitcoin is far less volatile now than it used to be. The next thing to consider is the creation of financial instruments beyond the Bitcoin ETF and the implication this has on hedging and taking profits. In the early days of Bitcoin, if you wanted to take profits after a massive rally, realistically, your only option was to sell Bitcoin. Now, of course, a bunch of people selling all at once is going to result in the price going down. However, if you're in Bitcoin in 2025 and beyond, and you want to take some profits or hedge your position, you can do that without actually selling your Bitcoin. You can buy puts on the Bitcoin ETFs, you can sell covered calls, you can short Bitcoin adjacent companies. There's a plethora of options to borrow against your Bitcoin. There are far more tools at your disposal to realize gains from holding Bitcoin without actually selling Bitcoin. The next thing that will prevent a massive 75% drawdown is simply the change in sentiment. Bitcoin is being embraced by the most powerful and well-capitalized institutions in the world. BlackRock, Fidelity, Van Eck, and even the White House. Long gone are the days where there was any remote concern about the government shutting down Bitcoin. The most powerful institutions in the world now have Bitcoin positions themselves and have a vested interest in the Bitcoin price increasing. And it's my hunch that it's many of the most powerful investors in the world that are buying Bitcoin during these 10, 20, and 30% drawdowns that we've seen over the past year and a half. Another chart we can look at to distinguish between pre-ETF and post-ETF is by looking at the drawdown from local highs. So as you can see, during the 2017 and 2021 bull markets, Bitcoin had multiple drawdowns greater than 30%, with some as high as 50%. However, during Bitcoin's generational run of the past few years, the drawdowns have been far fewer in quantity and far lower in terms of magnitude, only reaching a 30% drawdown one time. Another point to consider is that Bitcoin is now too big to fail. At its peak before the 2008 crisis, Bear Stearns had a market cap of roughly $20 billion. But Bitcoin today has a market cap more than 100 times greater. A 75% Bitcoin drawdown would result in $2 trillion worth of value being wiped out. This would likely result in catastrophic economic contagion, and central bank authorities would be forced to step in with stimulus in order to support the Bitcoin price. Now, the last thing to consider is the performance of other digital monopolies. Bitcoin is a unique asset class, and it's difficult to make apples to apples comparisons. However, we can look at other digital monopolies because Bitcoin has been treated by the market in a similar fashion. Bitcoin's far different than Apple, Amazon, Facebook, and Google on a technical and fundamental level. Bitcoin has a finite supply, and it has no centralized leadership team. However, Bitcoin has been traded in a similar fashion, and the market has had a difficult time understanding and wrapping its head around all of these different assets. This chart here shows the price of Amazon stock in log scale in white, and in orange, we look at the percent drawdown from all-time high. It bears strikingly similar characteristics to Bitcoin. During the early days of Amazon, it had a 90% drop from all-time high, it had a 75% drop from all-time high, a 65% drop from all-time high, but over the decades, it continuously marched higher, giving the shareholders exponential returns. It's quite clear that during the early days, the market was not exactly sure what to make of Amazon. Is this legit? Is this going to revolutionize the world? Or is this a flop? Now, with the benefit of hindsight, we know the answer to that question. Anybody can order a package and have it arrive on their doorstep the very same day. Bitcoin is transforming the world in a similar but even greater way. It's allowing any person with any amount of wealth to store their wealth across time without it being diluted and without it being confiscated. It is the perfect bearer asset with a finite supply, infinite divisibility, portability, and liquidity. Just like the market had a difficult time understanding the implications of Amazon, the market is having a difficult time understanding the implications of Bitcoin. However, just like Amazon, Bitcoin's drawdowns are becoming less potent over time. Most recently, Amazon drew down by 50%, but that was only at the behest of the largest money printing in history, followed by the aforementioned slamming of the brakes by Jerome Powell. It took a global economic crisis and the central bank violently reversing its monetary policy to induce a 50% drawdown in Amazon's stock price. Bitcoin will experience a similar trend in which its drawdowns become muted over time. So hopefully this video shed some light on my perspective and why I believe Bitcoin bear markets are a thing of the past. Now, I will play devil's advocate. What could potentially cause a 75% drop in the Bitcoin price? The main thing that comes to mind would be if Bitcoin were to violently rip up to 500K, 750K, or a million within the next few months. In order for Bitcoin to have a drop of 75%, it first must increase by an order of magnitude or greater. There are still hundreds of trillions of dollars of capital outside the Bitcoin system, and Bitcoin is going to absorb that steadily over the coming decades. One of the best ways you can profit from this trend is by mining Bitcoin. Bitcoin miners consistently produce Bitcoin at a discount to the market price. Currently, hosted mining clients with Blockware are able to produce Bitcoin at an effective price of $47,000 per coin. That's right. You can mine Bitcoin for 47,000 rather than buying it for 115,000. That's more than a 50% discount to the market price. Not only that, if you are based in the United States, the new Big Beautiful Bill has a provision that allows for you to write off 100% of the cost of Bitcoin mining hardware in a single year. This is called bonus depreciation, and it is a game changer. You can produce Bitcoin at a discount while massively lowering your tax bill. Whether you run a small business, a hedge fund, or you simply earn a W-2 income, Bitcoin mining can help you save big on taxes while also allowing you to accumulate the most important asset of the decade. You can get started today by going to mining.blockwaresolutions.com/consult. Schedule a free consultation and you can learn all about Bitcoin mining with Blockware and how you can unlock these benefits. Again, that is mining.blockwaresolutions.com/consult.